Hey guys, welcome to the Truth About Real Estate podcast. I'm your host, Matthew Ma, and today we're going to about financial expertise and talk to John Stoj from Verbatim. Welcome, John. Thanks for
Well,
coming to the show.
yeah, thank you, Matthew, for having me on. I know you're in San Francisco, and it makes me feel nostalgic for the time I used to spend there. One of my favorite cities.
Nice. I saw too when I was just taking a look. You actually came from a Wall Street background and even created a sushi restaurant. But how did you actually jump into financial planning and like why does that matter?
Well, that's a great question, and it's very meaningful to me because I spent the first half, 2/3 of my career on Wall Street working on what they call the institutional side. So I worked for investment banks. I did investment banking. I created securities, and then eventually I managed large portfolios of securities for institutions such as ING and SunTrust, and then we eventually had our own investment manager as well for a little while. That was before the financial crisis, about 10 years ago. That hit, and I just got kind of disappointed and tired of the business because I saw the sort of the underbelly of that side of the business, and I wanted to do something different. That's how I got into the sushi business, which was I wanted to do a 180. So I created
Completely different.
yeah, it was completely different, but it was a fantastic experience again. I did that for about 5 years, and I sold the company, when our son was born, and, did a little bit of a stay-at-home dad for a while, and then I kept getting drawn back to finance, and my friends who stayed in the investment and financial, services community, they kept telling me I should manage money for people, and that would be great, but I just didn't wanna do it because I didn't think that I knew how to manage money any better than the market for folks. And frankly, I was also a little familiar just from financial advisors, cold calling me to just basically either sell products or again sell their ability that they were somehow magically going to make me money and at the same time take a percentage of my investments every single year for that service. And so I wasn't too excited about doing it, but um, basically what happened was a friend of mine, he just pushed and pushed and pushed, and he convinced me to join him. And he was doing he had established a flat fee registered investment advisor, an RIA, and RIAs are supposed to be fiduciary. You have to act in your client's best interest. And he took it a step further because of RIAs can charge their clients based on a percentage of their assets or the assets under management model. But he took it a step further and said, I'm only going to charge a flat fee so my clients know exactly what they're paying. They know exactly what they're getting. The fee doesn't go up just because the market goes up. And I'm not going to try to convince them that I'm going to outperform the market. So that's a really kind of a long-winded answer to your question, but that's what drew me back into finance after being out of it for a while.
That's a great topic, actually, talking about RAs, talking about percent versus fixed fees, and then even your transition to like when I think back about, during the dot com and during the crash, Wall Street, financial planning, I see from I was younger back then too, but just seeing that too, like I saw some financial advisors, they were pushing products, and even when you're looking at it, like I don't know if that's actually in the best interest of the people, the investors, or is it best interest for themselves since they're actually building on that percentage, right? And they
Hmm.
say they outperform the market, but really, how in detail are they really doing? Are they experts at the market, and do they actually know the companies really well at one category, or they're just generalizing, right?
Yeah, well, I mean, the statistics are very clear. Yeah, S&P puts out an active versus passive comparison, performance comparison. Active investing, meaning the folks who go out there and try to pick stocks or bonds or whatever to outperform the market, versus passive investing, which is basically getting into the market using index funds and building. You still have to do these things. You can't just willy-nilly throw together a bunch of index funds and hope that's going to work out. You have to take some time to do it, but you also know that your job as an advisor is to create a situation where your client captures as much of the return that the market can give them, while paying as little as possible, frankly, in fees. And so there's definitely two ways to look at it. And of course, in addition to that, there's, as you mentioned, the product sales, and that's getting popular again because people are nervous about the stock market. And the more nervous people get, the more vulnerable they are to sales pitches about products that are going to magically protect you from a downturn, and things like that. And all of these products are usually insurance based, and insurance based products come with commissions, and they're high fee, et cetera, et cetera. Very, very seldom appropriate for most investors.
So even back then, and I was talking to another financial planning and even insurance agents who are selling whole life policies, and then some of them say, yeah, for example, those policies are great. It does a lot of things you can do. I think a little stretching, a little overpromising, and they even talked about like mutual funds and diversification, and even using their systems to readjust, always be readjusting to the market so that they're trying to outperform the market. Is that really true?
Um, well, if you ask them, obviously the answer is yes.
Mhm.
Let's just put it this way. There's a reason why so many massive buildings in cities are owned by insurance companies, and they have massive portfolios. And I managed $3.5 billion for ING at one point, and they have all this money. That's because they don't lose money.
Yeah.
They're making the money from you. That's just the way it works. They know what they're doing. They're not they are really smart folks.
Yeah.
And so the fees that are baked into those products are really, really high in general. Do they do some of the things that they say they can do? Yes. But the answer is also, or the other question I should say that people should ask is, are there more efficient and cheaper ways to do basically the same thing and even potentially outperform or do better? Because usually the market ends up doing better than those products.
Yeah, and I like that kind of thought process because, for example, when I see people talk about it, and I'm just listening as my own self as an investor, I'm like, I think some people are selling the product. Some people are actually providing really good knowledge and trust. And I like the part of people providing the knowledge and trust because they're saying, "Hey, here's different options you can choose. You really want to diversify your portfolio. You want to have different things like whole life insurance policies. You want to have real estate. You want to have stocks and everything. Not pushing one product as their own, saying, "Hey, this is the best. It's always the best. I just believe in and bleed it."
Hmm.
And like when you look at the numbers, just financially looking at numbers, like this is not performing as well as you think it is. And you compare this, and you're not telling me that, hey, real estate can actually perform better. You get all these benefits, taxation benefits, and residuals, right? While a policy might say, "I'll give you dividends," but then here's all these different assumptions. They should actually provide the worst case scenario. Hey, like for example, whole life insurance policy. Immediately, if something happened to you and you already signed, then you get that death benefit. But if it didn't, the normal practice of just creating dividends and value might be this average. And if you take that into fact with everything else, it might not be performing the best, but I'm selling this to you as a benefit, like a death benefit, not as a performance product.
Yeah, and so those whole life, universal life, cash value policies,
Mhm.
often they'll be sold in conjunction with some sort of um, bank on yourself or infinite banking concept, and all of these ideas. Well, none of them really work the way that they're purported to work. Can you pull the levers and make those things happen? Yes, but again. Uh, 99% of the time cheaper to do in another way. Um, and the reason that these things don't quite work the way the salesmen like to think they will, or like to present that they will, is because the vast majority of cash value life policies never pay out their benefit because people will pay into them for a certain amount of time. Either they'll figure out that they can't afford it any longer because these are pretty onerous payments, usually annual policy payments, or they learn after being in it for 5, even 10 years that this doesn't really make any sense, and they have no choice but to give up, take out what cash value is in there, which is theirs,
Mhm.
but again, is going to be, in almost all cases, that cash value within a policy is going to be much less than what they would have had in a brokerage account had they simply taken that policy premium and placed it into, say, a total market index fund or something like that.
Yeah, exactly. I was looking at it too. I saw like one policy is like it takes about 12 to 15 years to break even. I'm like, for that long time period, you could have invested in anything else and it would be better, except for the death benefit. And I
Yeah.
hope no one dies. So that's why I was like, okay, it's just a different avenue, but it's good for diversification. But yeah, if they tell you up front, hey, this won't break even for 12 to 15 years, but in case it happens, then you get this benefit. Otherwise, there's other performance metrics out there that do better.
Yeah, and listen, life insurance policies are a real part of the financial planning process. I'll say that not everyone needs a life insurance policy. You can get to a point in your life where either you have no dependents, your children, if you had children, they are independent themselves now. You may have no reason to have a life insurance policy, and hopefully, we all get to the point where somewhere in our lives we can cancel or let the term policies that we've had just simply lapse. And so there's nothing wrong with life insurance. In fact, like I said, it's a tool
Yeah.
in the financial planning process. But life insurance, in my opinion, is something that you should buy if you need it and buy it as cheaply as possible.
Yeah, that makes sense. And as a performance factor, people look at S&P 500 as just a general average, and that's the baseline, right? Everything else has to be comparable to that and do better. And even when you start taking into real estate for account, real estate, you can have the real estate, you can have the residual income, you can have taxation benefits if you do write off depreciation, and then factoring all the performance numbers, all the risk factors, comparing that against S&P, comparing against Bitcoin, whatever,
Mhm.
and seeing how it does. But yeah, diversification about that. How do you go about like really, start to work with a individual family or whatever, and then start financial planning with them? And how do they learn about all these different products? How do you learn about all these different ones? And like, are you specializing in certain areas?
Sure. I'm not a specialist in any certain area. And again, in prior part of my career, when I
Mhm.
was working on Wall Street, I was an asset-backed securities specialist, and I was one of probably, not tooting my own horn here too much, but I was probably one of maybe 100 people in the country that had the level of expertise on that particular topic where I was investing. But working with folks on their personal investment side, my job is actually to be a generalist. It's to know as much as I can about all the options that are out there for people, and then know where to point them if they need to drill down, or frankly, for me to learn about it. I've had clients that have had interesting situations. Maybe they're expats. They have overseas income. Um, Up until 2 years ago, I didn't know how to treat overseas income, taxation issues, and things like that. Now I do. And in fact, that's something that I love about my job, is that every time I meet a new person and get a new client, I have the chance to dig in, because what I'm going to tell somebody, if they ask me a question, they say, I've got this situation, and they'll spell it out for me. If I don't know what the answer is, I'm going to tell them exactly that. I don't know. But what they will know if they work with me is that I'm going to find the answer out for them. And if I can't find it, I'm going to find an expert who can work with them, and so that we could all uh, get to the sort of the optimal point in wherever they want to go.
Nice. And do all financial advisors have like a fiduciary duty to their investors?
Um, Not all of them do. That's a sad fact.
Mhm.
Some of them do, but can sort of turn it on and off like a switch. You could be dual registered. You could be a financial advisor working for a broker dealer. And when you put on one hat, your fiduciary hat, you're supposed to be working with that client only in the client's best interest. But then you are also allowed to take that hat off and potentially sell them products that broker dealer would like to sell. That makes things a little difficult for clients, and frankly, to know, why is my advisor recommending X, Y, or Z to me, and That frankly is why I structured my RIA the way I did, as a flat fee advisor. I'm an advice only advisor. There's a small group of us out there that it's growing, thank God. But flat fee or hourly, or project based advisors, the idea is, again, that clients know exactly what they're paying for, and they know that there's no reason for me as an advisor to recommend anything to them or point them in any direction that doesn't make sense for them. Frankly, because I'm not incentivized to do it. I'm not going to get paid any more for recommending a particular, say, maybe I'm recommending an insurance product to them, but I don't make any money off of that. Uh, I might, recommend that they do keep more money in this particular account versus that account, or they know also that, for instance, talking about real estate, I can look at their whole portfolio, and if they want to buy a piece of real estate and it's going to take money out of their investment, say stock portfolio, and they're going to then put that into real estate, it doesn't change my compensation structure the way it would change the compensation structure of, say, an advisor who had a client who had, say, the client had $2 million with that advisor. The advisor's charging, let's just say, the average 1% a year. So they're charging that client $20,000 a year to manage that $2 million. Say that client wants to buy $1 million property, and they want to take that money out. The advisor will then, their fee will then go down to
Yeah.
cut in half, literally.
Yeah.
Now, a lot of people are going to be, perfectly honest. I'm not saying these types of advisors are giving people the wrong advice. No, there are a lot of people charge that way, and they tell their clients exactly the what the client needs to hear. They are acting as fiduciaries, but there are those that don't, and the client can't know beforehand
Yeah.
how that advisor is going to work. Whereas if your business is structured, again, like mine, like these other folks, who are advice only, or and flat fee advisors, that that kind of monetary incentive is not going to drive the advisor's advice.
Yeah, it's kind of like real estate. You got commission based, you got discount brokers, you have certain percentages, fixed percentages, and they all work differently, right? And
Hmm.
there's always pros and cons to every side of things. So it's hard to say what's good and what's bad because even for a certain fixed cost, then I start thinking about, okay, how are they performing? You have to look at their service level and their reputation because some people, small percentage might say, hey, if I'm a fixed fee, I need to get mass quantity of people. So I'm just going to go in and out as quickly as I can to help as many people as I can without really putting thought process into it to really dig deep because 100 hours versus 1 hour, same price. I'm just going to take the 1 hour, right? Some people might go that route. Why am I spending all this time with a person asking so many questions, right?
Hmm.
So that gets
Yeah.
difficult too.
No, but then, so that's difficult. I would say that's difficult on our side. What
Mhm.
the advisors that we set up our businesses like this. Um, the way my friend used to put it is that there's plenty of money out there to be made. Uh, if I get a full practice, my practice becomes full to the maximum amount of folks that I feel that I can service, uh, to the best of my ability, I'm going to be making a fine living. That's
Yeah.
not a problem. Is it true that I'm not, if I can't, I'm not going to, like a client isn't going to come along that's going to come along with $20 million and suddenly double or triple or quadruple my revenue, going forward. That's not going to happen with my business, but that's okay. Because my goal is, yes, like everybody, to make a living, but my goal is to do the right thing by my clients. And it sounds, you know it might sound a little wishy-washy, or a little too I don't know, as if I'm trying to be holier than thou, but that's just the way I feel. And I think, or I would like to say, I know that my clients, appreciate that.
And you can really do a fixed fee, and even then for supply demand thing, you can increase your pricing over time too as you provide more value, more knowledge, and more expertise, and providing proof of like really doing really well performance wise for all your clients. You can just start increasing your fee. So still fixed fee, it's just increasing over time and going with the market too. So it's not percentage based, but it is valued really well to your expertise level.
Oh
So that's
yeah.
not bad too.
No, no,
Mhm.
that's for sure the case. I mean,
Yeah.
products are, like you name any product, people need to be comfortable. If they're comfortable paying for the product, they feel they're getting the use out of it. Yeah, that's the way it works for sure.
So back in the day, like what made you jump out of Wall Street and go to, a sushi restaurant business?
Well, that we could have a whole episode on that. But the quick story is that it was during right while the financial crisis was occurring. First, my first money manager went out of business because of our funding went away.
Mm.
And then a partner and I raised some capital to start a distressed fund, and we were going to invest in different types of securities that had been pummeled by the financial crisis that we felt there was going to be value there, and that was where my previous expertise was. And so we worked on that for about a year and a half, and frankly, I was right on the cusp of being one of the guys that could have been mentioned in the book The Big Short, was we were investing in distressed CDOs, collateralized debt obligations, all the subprime mortgages that had gone bad and all that back then. But literally 2 weeks before our first multi-$100 million transaction was going to close, the government bailed out the banks for the last time. And we got a call the next day from our banking counterpart and said, well, we don't need your money anymore, because, frankly, taxpayer money is a lot cheaper than hedge fund money.
Yeah.
And so that literally that action by the government closed our doors and turned out the lights on that business. And I was just so frustrated with that situation that I wanted to do something that was not involved with finance at all. And so that's what led me to the sushi business. And why sushi? I had a friend who from business school whose mom actually owned a sushi restaurant, so I had the ability to have some expertise. And the other great thing about sushi is that it's basically an assembly process versus a cooking process, right? Only thing you really cook is the rice.
Yeah.
Um, and so as long as you could get the rice cooking good, which is challenging, frankly, when you're doing it on a large scale basis, but we got there. Then you can buy the right product, create a operational system that could then assemble the sushi the right way. And so that's what I did. I felt I had the expertise to create that the procedures and the operations to make sushi production viable, and delivery, frankly, because that's what we did. And we delivered sushi, fresh sushi, for lunches to hospitals and schools, universities, things like that, all corporate clients, and then even restaurants who wanted sushi but didn't want to hire a sushi chef onto their staff. So it was a fun business.
That's a lot of fun because it's purely operational. So if you think about scalability, you can scale this massively. Especially you guys went to corporate structure. That's can be a lot of fun because you're building corporate accounts. That's way different and easier in a sense that if you can build the corporate accounts, you can create massive volumes and your scalability really easily.
Yeah, though that was frankly that's why I was able to sell the business, because a lot of food businesses, restaurants, just
Mhm.
when they stop, when the business, even whether voluntarily or involuntarily, the owner leaves, the
Yeah.
restaurant closes. But I built the business so that everything was documented. I had a book of business. I had clients that regularly ordered every single week. The same orders, varied, whatever. But so when I showed and presented that business to potential buyers, they could see exactly what they were buying, and they could actually apply valuation techniques to those cash flows, as opposed to just sort of hoping, well, gee, that's a nice idea. I want to hire, I want to put my name on that shingle.
Yeah, very true. You can actually even franchise the model too. Once you have it streamlined so well and perfected, you can streamline that same business practice to all across different, different locations.
Yeah, that was a dream. That was definitely part of my dream at the time, but it was a lot more important, frankly, for me to be able to be home with my son than to worry about doing that.
Yeah, it's nice because in the restaurant business, you're there practically all the time. But as a financial planner, you can actually be anywhere you want to be, right? And just have conversations with
It
people.
it really is, and frankly, the reason why the reason why I sold the business was my wife is a physician, so she would be on call, she would be overnight call, and like we started our production, our sushi production, at 11 p.m. because we had to do all the production at night so that when the sushi was as fresh as humanly possible when it was presented to the clients. And so, after the third or fourth time that I got a call from my general manager saying there was some problem and I had to go to the facility, at 2 in the morning, and my wife was at the hospital and
Yeah.
my son was across the hall. It just wasn't happening.
Yeah, that'd be too tough. You're not gonna wake up your son too and bring him, "Let's go."
No, no.
No
Although
way.
I have some pictures, but right before I sold the business, I have some pictures of him hanging on my chest in one of those papoose things or whatever.
Yeah.
While I was doing deliveries, because of some of my delivery drivers would be out sick or for whatever reason, and so I'd have to do
That's
deliveries.
tough.
Yeah, and so that was definitely a funny time.
And it's good too because it actually helped you kind of like restart, refresh, and then get settled in and say, "Hey, I actually love financial planning. I actually want to help a lot of people out there. They need this benefit. I can help them better." And build that trust relationship with them. And your friends are asking you for help anyway, so then it just fits right in perfectly with that.
Yeah, it fit a lot better than, and it led a lot it was a lot straighter of a line than you may otherwise imagine, because what I learned, I'd never worked in the food service industry before, but when I opened the business, I hired a general manager who had been 35 years in food, and then I hired a couple sushi chefs who knew what they were doing for local restaurants, and then everybody who came to work for the company, if they're what I learned was, if you work in food and then working with the cafeteria managers that worked for the schools and the hospitals and the companies, et cetera, that we delivered to, if you work in food, you really love, more than anything else, the look on somebody's face when they eat what you've just made for them and they like it. And food is a comfort item, right? We talk about that. Everybody wants meatloaf or frankly a nice bowl of ramen when you're cold and stuff like that. So whatever food it is that you're making for somebody, it's really, you want to make them feel better. And frankly, that's what I want to do with my planning clients. I want them to feel better about their futures because at least there's a plan in place. None of us can predict the future. I can't tell them that they're going to have X dollars, to retire, or their properties that they own are going to go up in value like they have over the last, little while. But I can help them put a plan in place that says, if this happens, we have a contingency. If that happens, we have a contingency. And if everything goes as it should, then hey, we're gonna be okay.
When do you start helping people? Like, I guess first question is this: when do people actually start getting financial planners, and what's the percentage of people you think actually have a financial planner?
I've seen numbers. I mean, the people who actually have financial planners or advisors is quite low overall.
Yeah.
I think in the teens, maybe. I think everybody, the way to put it that I like to put it is that everybody can benefit from having a financial advisor or a financial planner, but nowhere near everybody needs one, because there's so many things you can do early on by yourself. Little education, listen to podcasts, frankly, that people are putting out, such as yourself, that give people just the little nuggets. You don't need a complex situation, or I should say, you don't need to create a complex situation early on in your savings and investment career, for no reason. And a lot of advisors, especially the ones that are trying to sell you stuff, they're going to try to overcomplicate things to make you think that they're doing something for you. I heard Ramit Sethi. You may have heard of him, but I think he said recently that people don't really need an advisor or a planner until they have maybe $1 million of investable assets, and that may not be all stocks. You could have be in properties or whatever. And I mean, that's a rule of thumb, but it's not, probably not that far off. You can save a good amount of your money by yourself. Just open up some accounts. Uh, easy rules of thumb. Fund your retirement accounts, your tax advantaged retirement accounts first. Only then go start in taxable accounts. And then, like I said, my recommendation, this is, I'm not giving out investment advice on your show, but the easiest and best thing to do for a lot of people, and most people, frankly, is just to buy um, cheap index funds to capture the whole market. Don't try to make a hodgepodge of mutual funds in a or individual stocks in a portfolio. That's going to take too much time. Chances of you picking the right stocks is probably pretty slim, and it just overcomplicates things.
Yeah, I think that's the part. Like in the beginning, even when you first starting, like I started investing when I was 24 in real estate, actually. But even then, like there's like a lot of self education. You really have to go get it. And then in the beginning too, like how do you know who to trust? Financial advisors, what people say, what investors are saying, what everyone's saying, what CPAs and other people are saying, and then trying to figure it out yourself is tough because there's not like one resource, or there's like so many different variables and there's so many different ways. It's hard to choose which is the best path to do, which makes the most sense, beneficial for the client rather than the advisors, you know?
Hmm.
So it
Hmm.
gets a little challenging there. And like, for example, some people say traditional wise, they might say, hey, put your money in a bank, but bank inflation, you're not making money. Some people say, put it into like S&P 500, just that one alone, it probably outperform in general over time than you picking yourself. Others say, yeah, put it to whole life insurance policies, put it to real estate, different markets, but then it gets complex as you keep going. Some people say buy your own stocks, buy some Bitcoin. It gets tough to like really know. And you're like, well, I only have this much money. How can I really put it anywhere? And then I'm not an expert at it. Then who do I talk to about that? And are they even experts at that one, or they're generalists? And how are they performing too? Are they outperforming the market? Most likely not the case all the time, right?
Right,
So how do you
right.
find a
So,
financial advisor? Yeah, and how's that work?
well, there you can. I mean, we've all got our Google boxes that we can just crack open, and you look for. My recommendation is to you can look for. There are uh, networks out there that you can search through. The Fee Only Network. There's a network called NAPFA. It's an association of fee only financial planners. And then, frankly, just go so far as to Google flat fee or fee only financial planner or advisor. And then the great thing is that now people are putting information out there. I mean, I'm on podcasts, I blog. People can go to my website, verbatimfinancial.com, and they can see and get a sense for what I'm about. And you can do that about other advisors. And I mean, I work with clients across the country. Um, I know some people are really very comfortable with virtual. I know some people who aren't. So, like for instance, I have clients outside of San Francisco. They're great. Obviously, they're virtual because of certainly over the last year we haven't been flying around. Um, but I've also recommended advisors to folks who I know that operate in the right way, but to folks that want to walk or drive to that advisor's office and sit down next to the person. So, like I said, there's the number of folks that I really think are doing it genuinely in their client's best interests, that that they're doing it in the client's best interests. It's a smaller number, frankly, than the whole advisory business, and so we like to we often refer around. It's not easy, but it's definitely possible.
How do you guys go about like helping a client? Say, let's say this: I'm meeting you today online. I want to talk about financing. Like, how do you start figuring out what's best for them, or some creating some options for them?
Sure. Well, it's all about listening, frankly, to you, the client. I need to find out what you want. Where do you want to go? What do you want to do? What is your current situation? Everybody's got different short, medium, and long term goals and desires, and so I don't have a rote or a specific list of things that I do for every single client in a certain specific order. Now, do all these things usually have to be done eventually? Yes. You want to address things like estate planning. You want to address things like tax implications and being, optimizing your tax situation. And but that takes time. It takes time to get to know clients, and it takes time to learn what how things would benefit them the best, right? But yeah, I think to cut to the chase, the real answer is going to be, what do I do? What's the first thing that I do for folks? Usually, if they've got a portfolio of investments, we'll look at that portfolio and we'll see, okay, how can we optimize it again, tax wise and fee wise? Because a lot of times, the first couple of years that I'll work with clients is sort of housekeeping. Like, I will be cleaning up um, old portfolios that they may have had, sometimes, frankly, from other advisors that they worked with in the past, and they're in high fee mutual funds. They may be in stocks that they're nervous about because the stocks have gone up, but you can't just willy nilly sell them
Mhm.
because there may be tax implications and stuff like that. So the first thing that I end up doing with most clients is the housekeeping, and then we move on to getting to know each other, and then for me, that's where the meat of the planning process really takes place.
Yeah, and I think about this all the time. Like, when you think about it, there's so many different variables and certain things. Like, for example, you have asset management, you have family offices, you have CPAs, you have financial advisors, planners, you have other kinds of like hedge fund guys too, and then you have like lawyers too, for example. And you're trying to create a team, and the team has to communicate and work well together. Even insurance agents too, like does
Mhm,
insurance agents just sell higher policies when really the policies shouldn't be that high? You should actually diversify some of this, like for the lawyers say, into LLCs, agreements in different locations, protecting it. And then overall the whole thing gets better. But that's challenging too, because there's like, if you go to one company, each person has their own specialty, they sell their own products, they don't, not everyone works together as a team saying, hey, actually I don't need all this money here, you should put some money over here and then balance it back out so we're all good together.
mhm.
That's a
Yeah.
challenge.
No, it's definitely a challenge. And for instance, I am a solo practitioner. My firm is right now just me, and uh, a lot of RIAs are like that. We have to be registered to be an RIA, but I'm the only investment advisor representative of my RIA. But I have relationships, deep relationships many times with folks that are aligned. Their values are aligned with my values. And so if a client has chosen to work with me and I've chosen to work with that client, then we are also aligned. And they know that the people that I bring in, to work together with us, that we're all going to be essentially on the same page. I know that some people find comfort in, say, working with an advisor who is at a large bank, say, and I get that. I totally get that. I worked in those large banks for years, but it's often just like you said. The Just because the bank has all these different departments doesn't mean that the people in the different departments have ever even spoken to each other
Yep.
live before. So, you know, I get it. If people are happy with that, that's great. And if that works for them, more power to them. But that's, again, not the way I chosen to structure my business.
Yeah, I agree. It's just, for example, it's like in real estate, going for a big name box office or else going for independent. And it's really comes back down to the advisor. The advisor is the one who's really going to be helping you. So find the right advisor, not just the name on it.
Hmm. Hmm. Yeah, and that's the thing. I mean, I don't. Um, it's not as if I hold people's money. It doesn't
Mhm.
come to me. I custodian through TD Ameritrade, and I don't even have to custodian through them, because if people have had a long-standing relationship with, say, they've had accounts at Fidelity for 10 years, there's no reason they don't have to transfer it to TD just because I work with them. But I can be their advisor, and because I'm not charging them on an AUM basis. Um, they just pay me my fee. It's kind of an easy process.
Yeah. How do people choose the right financial advisor? How do they know when it's a good fit for them?
Um, well, part of it really does come down to a comfort level. I mean, this is a trust business, and that's why it's also a very sticky business. Once people get financial advisors, they seldom leave their financial advisor, even if that advisor may not be, frankly, always acting in their best interest, because it's a relationship business. And so, what what I always tell people is, and you'll see this if you read the articles on it, interview a number of advisors, see who you click with, because this is a relationship business. You're going to have to, if they're doing right by you're going to talk to your advisor a bunch of times every year. And when you encounter certain issues, I mean, you know happy issues, like your company going public, that's great. Sad issues like death or divorce, I mean, you're going to be in situations where you're going to have weeks or months sometimes where you're talking to your advisor on an almost daily basis sometimes. So you better get along with them. You better not not want to hear their phone ring or see their email come across your screen. And so that's part of it. But you've got to come up with these reasons to, even to pick those 3 to 5 people to interview and to talk to. And what I always come back to, frankly, is that if you want your advisor to be a fiduciary for you, that means for them always to act in your best interest. Why not make it easy on yourself and choose from a pool of advisors whose business is structured so that they've eliminated as many of the conflicts of interest as possible before you even start. Sort of, again, like I said,
Yeah.
fee only, flat fee, hourly, whatever, something like that. Again, versus you could interview 5 advisors who work under the AUM model, and a couple of them might be awesome, but you don't have that initial cut, which I think might as well make it as easy as possible on yourself to pick the right person.
That's true too. And one thing that comes to mind too is that when you do a fixed fee, you're actually getting one variable, getting rid of one variable that I like is that, okay, well, some people have like a minimum, like, hey, 50,000 minimum, 500,000 minimum, $10 million minimums. And then you can kind of tell, well, if you're under that price point, they're not going to spend as much time with you as they can spend with someone else being on a percentage base. They just don't have the time. Even if they want to help you, they just don't have the time to allocate to you. And if you were to help someone who had $10 million versus someone who had $100,000, they need to focus on the $10 million, just to be honest, right?
Yeah, it's just, you're just looking at yet another potential conflict of interest, and you don't know
Yep.
exactly what that advisor is doing, what's
Mm.
driving what they do for you,
Yeah.
and so that's, like I said, as many as those as you can eliminate, the better off you're going to be. Just starting right from there.
So basically, simplifying your clients' investments and also simplifying the process to find a financial advisor, simplifying the complexity of choosing them, so that way they're working in your best interest and trying to help align with you and understand what you're trying to do. And by doing that together on both sides of things, it makes it a lot easier to start working with a financial advisor faster because you're not having to think about all these different variables that are out there. Like, are you for me? Are you for yourself? Are you for him? And then all these things. So that's good that
Mhm.
you guys do that with a fixed fee. By the way, in general practice, what's the fee amounts that people charge for fixed fees and up?
Um, well, so people will charge, if they're charging hourly, you could see $250 an hour plus,
Mhm.
depending upon, again, sort of like you mentioned before, depending upon the level of expertise that that particular planner or advisor has, and experience. So, and then, my fee is currently $5,000 a year, for an ongoing relationship, financial planning, and investment management. Um, and I've seen people that certainly have charged less than that. I've seen people that go with a monthly rate. They'll charge, say, $300 a month instead of an annual rate like I do. And then, frankly, there are flat fee advisors who I know personally who charge as high as $20,000 or $25,000, annually, and that's because they are almost like, as you mentioned, family office advisors.
Mhm. Mhm.
It's just that they don't charge on a percentage basis.
Yeah. Yeah, it's definitely. And it next comes to my next question too. Like, for example, if you're working with asset manager, who's managing just your all overall assets like an office, right? Do you they you know they might have their own in-house financial advisors within the team, or sometimes people might say I need one financial advisor, I need an asset manager. Not exactly the same, but they're two. Then you're paying all these different people for to support your support your funds, but hopefully by then you have a lot of funds anyways that you need that support.
Um, sure. Okay. So you touched on a couple things. The first is that if you've got a massive team
Mhm.
working for you, you're probably you're paying for that team. So think of it like that. There's a if you have a $4 or $5 million or even many times that, and you're paying a percentage of that amount every year, those numbers get really big, really fast, and so yeah, it's going to support all these folks, but the question then becomes, what are they all doing for you? Do you need a team of five or do you need to be basically paying five different people, to take care of you? I don't know. Maybe
Yeah.
you do. And if you do, again, more power to you. But what I know is that the vast majority of people, including people with double-digit $1 million of assets and net worth, um, they usually don't need that. And to the extent that they think they do, they've been convinced that they do by the people who are selling these products and services, um, that basically just provides to send their kids to college, never mind their clients, right?
Yeah,
Um,
it can be. Yeah.
and so and you said the second thing that you hit on was, another question that you said earlier is, how do people know how to choose an advisor? Well, the first thing somebody should do is also ask themselves what they want, right? Do they want an asset manager or an investment manager, or do they want a financial advisor? And those two things are different because, an manager or an asset manager is going to look. They're going to concentrate mainly on that portfolio of investments, and then again, often try to manipulate it, so that it does potentially outperform the market. And if that's what you want, there are people out there that try to do that, and they may succeed some years, they may fail some years. But if that's what you want, go find a person that's going to do that. Um, but if you want an advisor who's going to take you, hopefully, from where you are right now in your life to where you want to go, wherever that is, whether it's retirement, whether it's a new career, um, if you want an advisor, then look for a person who focuses on advice more than asset management or investment management.
Do financial advisors give free consultations too in the beginning just to understand each other?
Oh, sure. No, some I know I do know some people who charge for initial meetings. Just basically, they try to do that to keep people from kicking too many tires. But
Yeah.
but 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 those fees are usually, if they do charge them, they're very small. $50 or
Okay.
$150,
Yeah.
and they're always refundable if you go with the person. But like, I don't charge for an initial call, and so I have no problem. In fact, I enjoy, spending 30 minutes, or to an hour on the phone with somebody to find out whether we would be a fit. And again, like a lot of times, you know, I don't want to say I turn away business,
Mhm.
but a lot of times that's exactly what will happen. I'll have a conversation with somebody and I'll say, okay, well, I'll ask them those questions. I'll listen to what they have to say. And the right answer for them, the fiduciary, let's put it that way, the fiduciary answer for them is for me to tell them, you don't need an advisor right now. You just need to do these three things and call me in 5 years. Because of just concentrate on your work, concentrate on advancing your career, on making your next big real estate purchase, that type of thing, and just keep your investments and your other things as simple as possible. When that grows, when your family situation changes, then an advisor might be something you want to look at.
And do you guys do any sorts of real estate investments, syndications, funds, other kinds of projects?
Well, I don't do
REITs?
it,
Mhm.
but real estate, is, um, a legitimate part of an overall investment portfolio. So that real estate can be can be in the form of REITs, a securitized product. Uh, that real estate investment could be in the form of syndication, which are more and more popular right now. And frankly, it could also be in the form of hard assets. And so none of those things are bad in and of themselves or good. It just depends on what that particular person wants to do. And so again, my job is to lead them through the maze and point them to the right folks that they might work with, and not allow them to either get taken advantage of or pay too much money out, versus the return that they might get.
And I guess in your portfolio or your clientele portfolio in general, or even as financial advisors, I, I see like I think a lot of people have a good percentage based on real estate assets. Even big financial companies that have like, for example, like 70% is based on real estate, something's based on bonds, a percentage is based on other assets and stocks.
Yeah, I mean, that's going to be something that is going to vary client to client, and it's going to vary based upon their risk profile, what their risk tolerance is, and their time, the time or point that they're at in life. Um, are they nearing retirement? Are they actually retired, or do they have 20 more years before they need to potentially access those funds? So the mix between bonds and stocks and real estate and other potential investments. I work with folks who are business owners, and so those businesses are also part of their investment portfolio. And you've the job of an advisor is to look at that thing holistically and to be able to say, okay, well, look, you've got a ton of real estate exposure here. So the last thing you need to do is buy REITs in your your managed portfolio, because of you've got plenty of real estate exposure. And so it it all depends on the person, frankly. So even when I say that you should, I recommend, or I am a proponent excuse me, of
Mm.
low cost index funds, total market funds, things like that. That doesn't mean by any stretch that every one of my clients is going to have the same portfolio.
Yeah. Do you guys, even for yourself, do you recommend your clients do like what kind of percentage do you recommend clients do the real estate investing wise? Even if every client is different, like, are you guys helping with that, facilitating that, and saying, hey, for example, for all the benefits out there, the risk out there, you should put X percentage or X dollars into some real estate, some form of real estate?
Um, I you know I always shy away from percentages like
Mhm.
that, because those percentages can change based upon the market. They can change based upon comfort levels, because that's another thing that you get to know your clients and you find out what they're really comfortable with, because the goal is one of my goals is to have a client that can go to sleep at night and feel comfortable, and then I tell them, or show them what the risks that they're potentially exposing themselves to. But uh, you know, having clients that really quote unquote like real estate and have, say, maybe 50% of their net worth in real estate, be it commercial or residential. That seems like a massive number, but their family may have been in real estate for the last 100 years.
Yeah.
And that's something that they're happy with. And so the idea, my job is to then offset the risk, because risk concentrations, hopefully you can offset those in certain ways. And you wouldn't necessarily recommend a high risk equity portfolio if you have a huge concentration risk in, say, real estate or something like that. Just throwing out things like that. So everybody really is different.
Okay. And for example, just looking at this here too, just thinking about all the different ways about financial advising, real estate investing. What do you think the current market is heading towards right now? And right now we're in the middle of 2021 pandemics. We're 18 months in around. What do
Hmm.
you think?
Hmm. Um, I have no idea. I mean, and no,
Yeah.
and that's the honest truth. I don't like to make predictions. They seldom work out for folks. What I will say is that I ask questions when people come to me and they'll say, "Okay, well, stock market's really high. I'm afraid to, invest, or should I sell?" And then it's my job to ask them questions. Is okay. What makes you think it is going to go down soon? Um, what are the other alternatives? Where would you put your money otherwise? This is what's happened in the past. I can't say that it's going to happen in the future, but we can look at these things and try to make decisions like that together, as opposed to me telling somebody that this is going to happen, or look out, the market might fall, because um, if you've put together a plan that is supposed to work uh, in various circumstances for you, then ideally it works independent of how the market is going. Because again, if you have 20, 30 years of potential earning power in front of you, then the fact the market is high right now and may go down sometime in the next year, or who knows, we just don't know. um, that's not really that impactful for you. If you are 2 years from the date that you've picked to retire, um, then if I've been working with a person, then we would have already had the process in place, and we would be moving towards a lower risk profile for you. And so the fact that the market is where it is doesn't impact what we're doing. What impacts what I do with folks is their lives, not what's happening outside their lives.
Yeah, and for me, like I like real estate a lot, so I look at just all the different factors. And even though I'm just analyzing, not predicting, just and looking at historic trends which are different. I like the fact that okay, now with the pandemic, you had a huge acceleration in business and just the way operations are running, everything becoming more virtual, becoming more global, and people actually have to accept it because everyone life changed immediately. It was a slow, long process, and they say that they just drew out so fast. That's why you see like companies like Amazon and other tech companies are scaling quickly because they already had that model adopted.
Right.
While the other companies, you see the old companies, they're struggling, they can't keep up, and they're closing because they didn't even think about this in the future, or how to pivot quickly to accept this would happen, right? So it's the
Hmm.
acceleration of it changes. So then you start thinking about, okay, what else is changing people's lives? How will life be different moving forward? How do things work at a global level rather than a local level? And then you start seeing, all the analytics, micro, macro behind it, and you're like, maybe assumption this could happen, but we'll see. And how does that affect real estate and affect your financing, right? And like, how do you take your risk level of low, medium, or high risk to correlate it with it and invest and hopefully make smart decisions with smart people? So that's
Yeah.
fun.
It is no, and that's super fun.
It's all
Don't get me
theory.
wrong. Yeah, I mean, absolutely love to talk about this stuff, and I will have conversations with clients about it. I love talking about. I'm a big fan of demographics, which is why I'm not. You could tell me what you think about this. I'm not worried about the real estate market, at least the residential real estate market, because we've got a massive slug of millennials who are entering over the
Mhm.
next even decade, the point in their lives where they're going to be buying homes.
Yep.
And so that's good. That all that should do is support this market. Now, I don't think we'll see the continued home price appreciation that we've seen for the last year. That was a little crazy and pandemic induced. But at the same time, I don't see anything that indicates a crash coming,
Yeah.
that type of thing. So I love to talk about that. I mean, I spent years just pulling in data from everywhere when I was on the banking side, and building big models and doing all that kind of stuff. So I love it. But it's not going to, that kind of thing isn't necessarily going to affect whether, my clients own X security versus another one.
Yeah, that's true. And it's just fun to talk about it because I know some institutional investor friends who
Hmm.
do this at a high level and they spend a lot of money per month doing it. And they have like data scientists actually analyzing the models, analyzing global economies and every single point factor of it. And they're showing you all these reporting systems saying, here's what's going to happen, here's why it's going to happen, here's the data to prove it's going to happen. It's not 100% guaranteed, but we really spend millions of dollars to make sure that we invest really well for our multi-million dollar clientele. I'm
Hmm.
like,
Hmm.
that's actually really smart. They took all data across the world and put it into systems and analyzed it and tried to predict it. But that's at
Yeah.
a high level. Normal people, we're not going to care too much. It's not going to really affect us. But at a big institutional level, it changes.
Yeah. But
Not
all I'm gonna
perfect.
tell you is that there were some big institutional models
Yep.
who were running, using essentially supercomputers to predict that there would not have been a crash in 2008. If if you go back and look at the research that all of the street firms, were putting out at the time, you know, eh, models are only as good as the data you put into it, and up
Yep.
until that point in time, there had never been a national decrease in home price appreciation ever in the history of the United States. So none of the models captured that. And
Yep.
but that's exactly what happened.
That very true. So yeah, it's only as good as the models, and there's a lot of things people don't know. Like who knew a pandemic would come when it would come too,
Mhm,
and what
mhm.
happens to the economy and amount of
Yeah.
everything that all the chaos that it caused.
Mhm. And then people act in certain ways. Humans act like humans.
Mhm.
Um, the U.S. market is massive. The dollar is still the reserve currency, and although you have people who don't like the Federal Reserve, and there's all these anti-Fed people who are gold bugs or now Bitcoin bugs, who are anti-Fed. Um, until there is a viable alternative, and it doesn't look like it's going to be the Chinese yuan, or anything else right now. Uh, then that's just then what does that all that turn into? It just turns into stuff that's fun to talk about, but I
Yeah.
don't see you right. And so the models, they're fun. They're fun to make. They're fun to talk about, but it's probably not going to affect
Yep.
your savings and investment.
Very true. Because yeah, it's all fun and it's all theory, and there's no 100% correct model. If there was, everyone would be rich.
Mhm.
Period. Right? It's
Yeah.
not. It's not the case. So nothing's perfect. So before we wrap up the show, like, what are some advice, some mistakes, some pitfalls you see clients, and how do people get going and get moving and start building real financial wealth?
Sure, sure. Okay, so I'll give you, a couple of things. I touched on this earlier. If you're young and you're starting out, if you're like a Gen Z, I mean, your superpower is time. Just start saving, and it doesn't have to be a massive amount. But I do say save as much as you possibly can, uh, and then keep your personal expenses low as your job. You get raises at work, your career gets better. Just keep increasing your savings and keep that savings and investment as simple as possible. And you will be shocked. I've heard some people say, open up a Vanguard account, buy the total market fund VTI every month, and lose the password to the account because if you don't want to look at it every day. So that's for young folks. That's the best advice that I could give. I know I lost a ton of money because in my 20s I thought I was a smart guy and I thought I could uh, pick stocks, and so I did invest and I made a little money, but I went back and I looked and I would have had several times more money had I just simply put it into a S&P or total market fund.
Yeah,
So
I
that's
agree with you on that one.
yeah, so
From experience. Yeah.
that and then for people that are a little bit older, one of the things that I'll tell them to do, they can do their own financial housekeeping. I do this with people. This, like I said, this is a big part of what I do for folks, but they can do it themselves. If you've got an old 401k or sometimes more than one old 401k from different jobs, go back and look at them. Open up the statements that come, because you may have picked the best mutual funds available to you at the time. in 1999 to go into that 401k, but it's 2021 now. Chances are those funds are probably not the most efficient funds anymore. They may not be the right funds for you at the point of where you are in your life. And so look at these things and make conscious decisions, even with those old accounts. And then you might find, over the course of time, that can benefit you greatly.
Cool. That's a great advice for people. So be sure to, talk to John about it. Look at his website, Verbatim Financial, and contact John about any questions regarding, financial advising and how he can help you and your people, family, invest and really think about how to clean up your portfolios, how to maximize it, and based on your age, based on your financial, goals, and how to best work with you on that. So where do they reach out? How can they contact you?
Um, the best way is to go to my website, verbatimfinancial.com. It's really it's got I've got a little button there that says reach out. Again, they can look at my blog. And then I'm also on social media, probably more than I should be. I know my wife says I'm on it more than I should be, but my handle on basically every social media site is the same. It's STOJBOJ, which is, it's actually pronounced Stoy Boy, because my Stoy, the J is a lot, and it throws a lot of people. I sort of made it into my
Cool. I think we lost you a bit. Oh,
Oh.
there you go. Yeah.
Yeah. Well, I don't know where you lost me, but
right after contacting you. So be sure to check you out, shoot you an email, check out your website, hit the reach me button, and then for everyone out there, thank you so much for being on our show, the Truth About Real Estate podcast, and we'll see you guys in the next one. Have a great day.